You say, quite simply, the market is in crash mode, and a large drop, a significant drop on the Dow and Wall Street in general is likely, in your opinion. Now, this is not advice. We're not telling people what to do or not do with their money, but you think that all the indicators are not, a lot of red flags is what you're saying.
Yeah, that's right. If you look across the board, the indicators are flashing red. So there's a few things that are going on here, but probably the primary driver right now, Steve, is that interest rates have taken a pretty sharp rise up, right? You got a 10-year treasury right now at 4.81%. You've got a 30-year treasury at 4.94, right? So those are competitive alternatives to the stock market, first and foremost. But forget about that for a second. The stress that that's going to put on the financial system, if you go back to March and look at what happened with Silicon Valley Bank, which was kind of the first bank to fall, the 10-year treasury back then was at 4.09. It's at 4.82 right now. So all the collateral that those banks held that was damaged then is even more damaged now.
Yeah, and I'm looking at something else here because this seems counterintuitive to me. And you said, look at this, the price of gold, $1,822 right now. And the guy that we talk to about gold on a regular basis says it's very much becoming a buyer's market. But you say that gold and other commodities could be falling as well, and for a bit farther. Why is that? To me, it's counterintuitive. If the market's not good, to me, I would think that people would buy gold. What's happening?
I think that's a bit of a misnomer. Okay, first of all, buyer's market means that the price is falling, right? A seller's market would mean the price is rising. So the fact that the price is falling on gold makes sense. Right now, Steve, what's happening, in my opinion, is the smart money is looking for the exits. And the reason that I think that is you look across asset classes, stocks have gone down. Actually, ironically, government bonds have fallen far more than the stock market has so far. In terms of the yields have gone up, but the prices have come down. In fact, you look at a 20-year treasury, it's down 20% in the last couple of months, right? That's like meme stock movement. That's not supposed to be risk-free government securities. So if you've got stocks falling, bonds falling, and now gold is falling, it's a search for liquidity. And what's happening is the smart money is exiting risk assets and it's looking for safe haven places. And where is that? U.S. dollar, cash, short-term U.S. treasuries. Every major downturn, this is what happens. The money leaves the risk assets and it goes and finds a safer place.
How long did it take us to survive or sort of bounce back is a better term after 2008, 2009? How long did it take for those assets to return? Because a lot of people are just going to stare at it. They're not going to touch it. If they're not retiring now, if they're 40 years old, they don't care. They're going to leave it in the drawer. They'll look at it later, right? What is the time frame to come back, historically speaking?
Well, here's the deal, Steve, I'm glad you brought this up because this might be the most important thing that we talk about. We were lucky, you and I were very lucky to live most of our adult lives in the longest running period of peace, prosperity, economic success, technological innovations, all that stuff. And so, we're used to when the market goes down, it just bounces right back up. And a lot of that has to do with a massive increase in the money supply and the Fed being very accommodative and supporting. The problem that we have now is that the Fed is backed into a corner. We have $33 trillion in debt and growing. The politicians are in control of the money printer right now, and they're out of control. And the markets are shooting a warning shot over the bow of the politicians by saying, if you don't get your fiscal house in order, we're going to make the rates go so high that you will not be able to afford to take on any more debt. And so you will not have the Fed run in and bail out the markets.
So to be clear,